Hello my fellow freedom builders and welcome back to the channel. Now today's question is the one that everyone wants to get answered, and that is, has the market bottomed? Now if you don't want to hear my lengthy explanation, I can tell you right away that yes, I think the market has bottomed. There are some technical issues where we are starting to see some higher tops and higher bottoms on a weekly chart, but there are also some fundamentals that I would like to go through. It might be a bit nerdy or detailed or whatever, but I will do it as simple as I can. First of all, many of the arguments I'm getting about the market can't have bottomed yet is that people are saying we are awaiting a recession, and until we have had that, we simply cannot get a bull market because there are some historic data about how the market behaves during a recession. So if we are going into a recession, we should get some more bear market, some more downturn in the market. I tend to agree with that, but that leads me on to another question, and that is, are we really in a recession right now? Well, let's take you a bit down the rabbit hole here. First of all, what is a recession? Well, you might know the term, the GDP, the gross domestic product, that basically measures the total monetary or market value of all the finished goods and services produced within a country's borders in a specific time period. All right. And the simple definition of a recession is that we have 2 quarters in a row with a negative GDP growth when we annualize it. All right. So far, so good. The GDP is basically the services and products, the value of the services and products that are being produced in a given country. So if we're looking at the United States, it is all the services and products that are being produced within the borders of that country. All right, so far so good. Now, if we are looking at the GDP here, we can see, let's take it on an annual basis here, we can see the GDP in United States from year to year. We can see that it has been hovering around 2%, a bit up and down here, depending on the presidents and what stimulus packages and so on. Of course, there was a 2022, there was a negative GDP growth there, and that means we had the recession there. That's the last recession, and if we're looking further back, we can see that there have been another one in 2009, 8-ish here in the financial crisis, and of course there have been other recessions back in time. Now, you might say we are not in a recession right now, and you are correct. At least when we're looking at the what is called the normal GDP, a full year GDP growth. However, I have a little argument here, and that is that we are actually in a recession. Now, how can I say that when everyone else, Fed and all the clever economists are saying that we are actually not in a recession? Well, that is because I like to look at what is called the real GDP. And the real GDP takes the amount of money that is produced, or the goods and services, the value of these measured in dollars that are produced in the United States in a given year, 2.1% in 2022. We can see it here quarter by quarter. In 2022, we can see that it is dropping, and it is expected at some point to reach recessionary territory. However, it is not there yet, if we are just looking at the GDP as that is normally done. However, when we're looking at the inflation, and this is the core inflation, this is not even the real inflation. This is not including food, and it's not including fuel. I normally like to look at that instead, but let's just have a look at the core inflation, because that is what Fed and many economists like to look at for some strange reason. And what we can see is that the core inflation for a year when we had finished the 2022 at New Year here was 5.6%, meaning that the money in United States over the last year had decreased in value by 5.6%. Now let's have a look again here. Here, and seeing, okay, we are producing goods and services that are 2.1% more worth than the year before. That is all well and good. But what if the money have gotten 5.6% less worth? That actually means that we are having a negative GDP growth, a real GDP growth of 3.5%. I know this is not the way it's normally calculated, but the fact is that it's a bit like when we are talking about the real wage growth. Now, if you're getting 2% in wage growth 1 year and you're saying that's all good because I can buy 2% more goods. But then we have some inflation saying no, because the goods are now costing 10% more. Then you're saying, well, then I actually got an 8% wage cut. My salary is now, I can now buy 8% less goods with my salary. That is exactly the same we're looking at here when looking at the real GDP. So having an inflation, a core inflation rate of 5.6% combined with the GDP here of 2.1% actually gives us a negative GDP growth. So I have heard people saying, yeah, well, it actually feels like we are in the middle of a recession right now, even though the official numbers don't show it. And this is exactly why. It is because, yes, we are producing in dollar terms more goods and services. It's just that our dollars are worth a lot less. So basically the GDP is dropping. That is my argument here. Now, let's take it a step further here and have a look at, because my question and the title to this video is actually, has the market bottomed? First of all, looking at the technicals here, I can tell you, I know many people are saying this is just the beginning of a new downturn. This is the weekly chart of the S&P 500. And yes, normally when we have seen other crises, let's say here back in 2008, we also saw some large jumps up of 15% and 12% and so on. But what we didn't see here was, if we are looking, let me find my drawing tool here, we have lower tops and lower bottoms all the way down here until we started to actually bottom out, and then we went up from there. It's the same with the other crises, the market collapses we have had. Now what we are seeing here is actually that we are beginning to see rising tops and bottoms, and we are not normally seeing that in a market that is going to collapse from there. I'm not saying it can't happen, I'm just saying that this actually indicates that we could be seeing a bottom right now. That leads me to the next point in my argument here, and that is the earnings. Right now we are in the middle of an earnings season, and now if we're looking at the S&P 500 here, this is from FactSet. I will put a link to this in the description of the video below. But here you can see back to Q2 of 2019, and you can see the what is called the end of quarter estimates, meaning that this is the gray here is what is estimated for the S&P earnings, the growth in S&P earnings for a current quarter, and this is what is actually happened. So if we can see here, we can see that the estimates were minus 4.3%, but the actual growth was only minus 2.2%. Next quarter, there was expected the overall S&P earnings to be minus 1.8%. However, it was actually positive 0.8%, and so on and so forth. Now, what you can see here, and this is the last recession we had in 2020, with all the illness, we can see that it was actually expected already that there would be some downturn. There was some skews in the economy, and we can see that it was expected with some negative growth here, but it got a lot worse. Okay, so far so good. Then the virus really came rolling in, and everyone was expected the world to basically collapse. And it was expected that we would see almost a 44.3% negative earnings growth. However, we only saw a minus 31.6. I know this is large, but we'll have a look at the chart in a second, because this is in Q2 2020. Let's have a look at Q2 in 2020. Let's just have a look here, see if we can get them in the quarters here. All right, we have here the quarters, and we can see that this is Q2 of 2020. So actually what we can see here is that the company is starting to perform a bit better than was feared, than was expected. And actually 10%, 13% less growth cut. So what we saw here was actually that people had overestimated the bad times, meaning that this crash was overestimated. Where people had simply sold out too crazily in this coronavirus. Then we saw that the next quarter, the Q3 of 2020, people were saying, okay, it actually seems like the world is just getting a bit around on its feet again. So we expect only around 21.2% in growth cut. But the world did a lot better. The companies did a lot better. We only saw 5.7%. And that can be read directly into the graph here. And that was the reason why the prices just skyrocketed. So what we can see is actually that the quarter where we are doing better than expected is often the quarter. Now this is of course only going back to 2019, but I have numbers further back. And we can see that the quarters where we are bottoming out and then starting to do better than expected, these are actually the quarters where the markets are really turning around. What we can see here then, if we follow this, is that in Q3, Q4, we did all well here. That was, let me see, 2020, that was up until here. Then we got into Q1 of 2021. We expected some growth. It was crazy good, of course, because it came from a very low level. So these are outlier numbers, no doubt about this. Otherwise, we couldn't grow the earnings per share with 90%. It's only because it came from an extremely low point. This is percentage wise, of course. Then we came into the last half of 21, and of course less growth was expected because we were now on the good side of the virus crash down here. So people were expecting less growth, but yet some positive growth. We did better than the market, better than the expectations, again better. And then it was only in Q3 22 we actually started to do a bit worse, or at least just about the same. And that is in 22 here where we can actually start to see the things are falling a bit apart. Now what we can see here is that the expectations are dropping, the actuals are dropping, we're still doing a bit better, but then we go into the negative. We have the 22 when we had the war in Ukraine and so on. We had crazy high inflations, and Fed had started to talk about higher interest rates. That was back here a bit more than a year ago, and they started to hiking the rates quite quickly. Now what we can see in Q4 22 is actually that the earnings had been expected to be negative, but they were worse than expected. So that is this, what we can see here. That is the really quick downturn. Then we got some better than expected, a downturn again, and this has just been a bit of a shit show to invest into. Now what we're looking at now, and that is of course the interesting thing when I'm asking, have we seen the bottom? Because right now we have some expectations that we'll see some earnings cut of 6.7% here in the Q1. We are right in the middle of the earnings season, or just starting out on the earnings season right now. But what FactSet can see, and at the point they did this, only around 6% of the S&P 500 stocks had come out with their earnings. But what they could actually see was that they are outperforming a bit. If we're looking at the earnings calendar just from yesterday, for instance, that was the 18th of April, we can see that we got a bunch of the big names in. And here I'm basically looking at earnings per share, EPS. I'm not looking too much at revenue. The revenue are dropping a bit with some of these companies, but they were prepared for this. They were prepared to go into a recession. So even though that the revenue is actually dropping, we can see this is the previous, then there's the forecast, and then there's the actual. And what you can see here is Bank of America beating its forecast. Bank of New York Mellon doing just as it was forecasted. Goldman Sachs doing better than forecasted. Johnson & Johnson beating the expectations. Lockheed Martin beating. Prologix doubling. Then we have Interactive Brokers doing a bit less here. We have Intuitive Surgical doing a bit better. I know that there are some guidance we should also look to, but I'm just looking at the earnings per share here. What we can see yesterday, we can see it again today. We are having, let's see, we're having Abbott beating, ASML beating, we are having Morgan Stanley beating, Travelers Companies beating, US Bancorp beating. So it seems like the trend is turning a bit. And if FactSet is right, that we might end up in a bit of a negative earnings per share growth here. I'm not sure it's going to be overall positive because this is just beating the earnings and not beating what was last time. But what if they're right and what they're seeing in the trend is correct, then we are going to see at the end of this earnings season that the Q1 ended a bit better than we had feared. And if that is correct, that actually tells us that we are in the middle of a market turn, at least if we should believe the statistics. That means that what we are seeing here with higher tops and higher bottoms are actually the beginning of a new bull market. And then we can go back to the argument with people saying, oh yes, but we haven't seen a recession yet. And my question is, really? Haven't we? Because we have seen a recession in the real GDP when we are looking at the GDP minus the inflation. So if they can bring the inflation down, we might actually see some further quarters with negative real GDP. There can be several quarters before we are seeing, for instance, a 3% growth in GDP and only a 2% growth in the core inflation. I think that will take a while. So we might actually be in an area now where we are going to see a recession in real GDP, meaning GDP minus inflation, for, I don't know, the next year or a year and a half. I don't know, depending on what the market will do. But that just tells us historically that the market normally turns in the middle of a recession. That is what we can see in many recessions, that it bottoms out sometimes in the recession and then starts to build up from there because investors' expectations have been dropping, and now all of a sudden the companies are not doing quite as bad as was feared, and then the market starts to climb upwards again. Also, many of the recessions, when we are looking at them, we can see, let me see, we have the numbers somewhere. We can see that the return of the S&P 500 over the recession period, and we can see it actually varies very much. We can see that in 2007 to 9, we can see that it was down at minus 37%. Overall here in 2020, because the market dropped and then completely recovered with lightning speed. It was not very big, but we can see some of these recessions, the larger ones, have been down at 30 or maybe 40%. And if we're looking from a top to a bottom here in the S&P 500, we can actually see that we are down close to 30%. So it's not even certain that we should further down when we're looking at historic numbers. Now, this is just speculations. This is just me trying to put together some statistics here so you can get a picture of what is actually going on. But what I can tell you is that from a technical point of view, but also from the macro point of view, looking at the GDP, the real GDP, and on the potential turnover here in earnings growth, I would say that there is a good likelihood of the market having turned and that we are going to see an upwards movement from here. You might be listening to some big analysts saying that, oh no, the world is going down in a hole and we are never getting up, and we are going to see a 50% cut in the market. Some are even saying a 90% cut in the market. The thing is that many of these analysts have been saying so for the last 20 years. And many of them actually predicted that January would be just about the worst month ever in the history of stock markets. And what the market, just the S&P, were up 6 or 7% in a month, and the Nasdaq were even better. So don't put too much credibility in these analysts. No one can predict what is happening. Me neither. So it could be that the second I upload this video, the market turns around and just shoots downwards with 90%, and then we can all have a laugh about that, at least from my video point of view, not for the overall economy. I have put some arrows on here, and that is from my statistical cycle indicator, indicating, and that was before this week started, that this week could be the week where we're going to see 2, 3 or 4 weeks of some selling pressure. So don't be surprised if we are going to get a bit down here. What I will be looking for is if this bottom, weekly bottom, will be broken. If this one gets down here, and we are seeing something, I don't have an indication for that yet, but let's see, say it's here or here, we're going to see some indication of potential buying pressure coming in. If the market has only got down, let me find my drawing tool here. If the market has gone down here at this point and we are turning around, it is just a confirmation of this uptrend. If, however, we have broken this bottom here, and this is the new, then we have a new lower bottom, and then the picture is completely different, and I'll have to reassess my my thoughts about the market. But this is how I look at it right now, and I hope I'm right, because I really hope we're going to see the bottom in the market and that we can really shoot up and make some good money from here. That's all for now. Take care of yourself and your money out there, and please leave your comments in the comment section below if you have some ideas of where the market is going. That's all for now, folks. Bye.